Let's review our trades for today. Today is Friday, September 8th of 2023. We did 3 trades in our main option trading account. First of all, we bought to close the NEP September 15th $50 call option. Now this was part of a bearish call credit spread that we had sold in NEP. If you remember, we are also in a covered call position in NEP, and with it declining so much after it was assigned to us, we're trying to repair this position. So we had sold some extra bearish call credit spreads. We got $1.50 per share for that spread, so we closed it out for almost max profit at just 20 cents per share. And we'll look to enter a new bearish call credit spread as long as earnings doesn't sneak into the next option cycle. All right, the next trade is PayPal. So we bought to close the PYPL September 15th $62.50 put option, and we only went out 1 month, but we rolled it down to $57.50. But in order to do that, we had to sell twice as many of the October put options as September ones that we were in, which is fine. We were only in 1 cash gear put option in PayPal, so we simply had to double that at 2. And we still walked away with a small credit of 10 cents per share. Let me show you why I decided to do that. So here you see our charts, and PayPal's kind of been a little bit all over the place the past several months. But it appears to be, if you look over here on the weekly chart, it appears to be trying to find a bottom. Problem is it just barely keeps making a new lower low. So you see here this low back in May. Well, unfortunately, the one right here in August was a little bit lower. Now we look at our highs here, that's right there about the same. So it appears PayPal is trying to reverse this trend. Notice it really hasn't gone anywhere, going all the way back here to February of 2022. So about a year and a half ago, PayPal's kind of been trading in a zone from around 100 and, well, this really is kind of right in here. So really about 100 down to around 60, 57, 60. So kind of stuck in that range, and it is compressing. It is hitting up against this green 50 moving average. So at some point we expect it to really challenge that and try and push through it. So we'll see if there's enough buyers to do that. But just in case it continues to be weak, I decided to go ahead and roll that $62.50 strike price down. So we were right in this vicinity right in here around 62.5. That was definitely in the money and well above the lows recently from several weeks ago. So now we roll that down, we're right at the money. So able to get it down to right at the money and only double it to 2 contracts. So we're still good with that. We still have plenty of room we can add to this if we want to. All right, then we had this trade sitting out there just waiting for it to get hit, and finally today I decided to adjust it a little bit. This is a new ratio spread in SWK. So what we did is we sold one of the SWK January of 2025 $90 call options, and that's at the money. And then to cap our potential loss, we bought one of the SWK January of 2025 120 call options. So that caps the $3,000 max loss if just this thing falls apart on us and we do absolutely nothing with it for the next, what is that, a little over a year and a half, about a year and a half. And then to give us potential explosive growth, we bought 5 of the 145 calls. And we did this for a net credit of $75 minus commission. So let me show you why I decided to go ahead and pull the trigger on this today. So might be a little easier to see here in this weekly chart. So of course we know Stanley Black & Decker has come way down. You go all the way back to, let's see, this was the summer of 21. It declined 68%. Looks like 68%. So a big decline there. And now it's kind of just been trading sideways, and now it's starting to make higher highs. So it's starting to get interesting. Notice this high here was around 96, and then the high from about a month and a half ago was about 105. Now we're also seeing higher lows. We see this high, this low here, about the same as this low here, but if it has indeed formed a low over the past few weeks, then we're looking at a higher low. Now volumes, look at volume here. Notice over the past month or so, although buyers showed great strength for about a week here, when it got to the upper part of this trading channel, sellers pushed it way down, pushed it down to the bottom of this channel, found support right here, so we're able to draw a new support trend line that's upward sloping. Now we find Stanley Black & Decker right back at that trend line, almost to the penny. So it's really close. When you see here, it's almost to the penny where it was at today. So the question is, can it bounce off of there? Well, it also is trading around this 200 moving average and just below the green 50 moving average on the daily chart. Looking at the weekly chart, we see part of the reason why it's struggling is trying to push through this green 50 moving average on this weekly chart. If it can do that, then we do expect it to go up quite a bit. If it retests the previous high, it'll go up to 105, so that'd be about $14 higher than it closed out this week. And to the top of that channel, it'd be up to around 113. So if it can push through there, looks for potentially an explosive move up. And notice that volume hasn't been that high as it's been declining. In fact, looking back over its history, volume's been fairly low as sellers sold it down. Of course, last week was a green up week and the volume was lower than the previous one. So buyers aren't showing great strength, but we're at support on multiple time frames and it appears it's trying to reverse from a downtrend to upward trend. So potentially, there's a potential here for an explosive move, and that's why we did a ratio spread. So we'll see how this trade plays out and adjust it accordingly or close it out at some future point. So that's all of our trades for today and for this week. I hope you have an awesome weekend.